Hey, I'm Andrew Cox back here alongside lead economist Anthony Smith. What's up, my man?
So we're talking about the FOTRI, how it did it again. So we have a real quick recap, the green line here, the flatbed outbound tender rejection index. Essentially, it eased down just a bit. Easing, very lightly used because it's still nearly 23%. That's still very tight capacity for our flatbed outbound tender rejection index. And so we have that compared to the blue line here, the Institute for Supply Management's PMI, and that's going to be the Purchasing Managers Index, and that's going to be indicative of manufacturing activity. So that also, again, eased down, but to 59.5, still very much in expansion territory, showing and signaling that there is still a lot of activity still to come within the manufacturing sector. So using this green line, using the flatbed outbound tender rejection index, you can really get a head start on seeing what's happening near real time within manufacturing and of course within construction. But the green line, the flatbed outbound tender rejection index, really has been the canary in the coal mine, so to speak, for what's going on within the industrial sector so far throughout the remainder, or throughout 2020 and going into 2021. In our next chart, we're going to look at one of the major breakouts that we've seen within the PMI, and that's going to be within prices. The previous week, we saw that prices were at 92.1. That's the highest level since 1979, and so that's something significant there. Inflation, of course, very high during the late 70s and early 80s, Andrew?
Right. Yeah,
maybe a little bit before our time.
Yeah, so thinking for anybody who isn't aware of these PMIs, this is our pricing portion of it, but it's still built the same way as the overall indice or the overall index there, where anything above 50 in this case points to expanding costs, right? So we're not at the all-time high there at 90, but we're still very high right now, which is indicative of fast-growing costs.
Exactly,
correct?
exactly. So that easing down is just, oh, it's not as bad as the all-time high since 1979. And so it's still very much very expensive. One of the big things that's going to be driving up those prices, of course, those commodities. A little bit more easing in those commodity prices, but there's still going to be some inflationary pressures around that. In our next chart here, we're going to look at one of the dynamics within manufacturing employment. Of course, we're talking about it not too long ago on our previous shipper update, and how the employment within the market is going to really be undergoing some changes. Econ 201, looking at that curve on adding more capital versus labor, it's going to be more capital intensive, more technology entering the space. These warehouses are going to be, and there already are a lot of Amazon warehouses are already tech hubs, so to speak, and so that's going to really make its way throughout the remainder of these manufacturing industries as more technology enters the field and the space. These workers within those fields are going to become more programmers, more coders, more overseeing that these machines are operating efficiently and according to how they're supposed to, aiding more of these really, I should say, production enhancements to kind of really push production, make it a little bit more faster, make it more efficient, and kind of keep things moving. Speaking of keep things moving, we have our next chart here, employment overall. This is one of the big releases that we had just this morning, showing improvements in overall the unemployment rate, Andrew.
And so this unemployment rate, we're looking back at the month of June, it was great progress. We're down from 5.9 to, I think you said 5.4% earlier. What were the kind of data coming out of the initial jobless claims? I know these are two completely different sets of data here, but the jobless claims can be a little bit more real time given it's just last week. So, and we've hit kind of a sputter spot where we cannot really kind of crack below that 375 mark. What were the results like yesterday?
Definitely. So 2 weeks ago, 400,000. This last week, 385. So a downward movement, not a pandemic low, but downward movement. And you're just exactly right. It's just, we saw, I know this isn't the initial jobs claims, but we saw—
That followed a very similar path here.
Very similar path, because it was a rapid decline. We saw a lot of more people returning back to the workforce, and then it just kind of hovered, and it kind of hit that sputtering moment. So a lot of variables at play here, as you know. Delta variant going to kind of throw a wrench in a lot of people returning back to the workplace. Quit rates are also high, so there's not just people entering the work field, there's also people leaving in search of a different job or testing their prospects out in the workforce. So that's also a factor here. But in the most recent unemployment update, we did see that there's, of course, an increase in hospitality services. We also saw an increase in business services. So a lot more people getting back into the workplace. Also a good sign. I think this payrolls increased 943,000 individuals. So quite a significant increase for this most recent report.
Yeah, very impressive quarter. I think we still have a very high quit rate right now. We still got millions and millions of jobs open, and prospects are good for workers right now.
Exactly.
Thanks so much for the shipper update.